In January 2009, one of India's most respected billionaires wrote a letter, confessing to a lie worth over $1 billion. A lie that fooled investors, auditors, regulators, and the global tech industry. And with a single admission, he shattered the reputation of one of India's biggest IT companies. Today, we talk about crypto frauds and billion-dollar startup collapses. But years before that, India witnessed a corporate scandal so massive, it was called India's Enron. This is the story of Satyam Computer Services, and the man who built it, then destroyed it. In the late 1980s, India's IT revolution was just beginning. Global companies were discovering that India had something incredibly valuable. Millions of highly skilled engineers working at a fraction of Western salaries. And one entrepreneur saw an opportunity. His name was Ramalinga Raju. In 1987, Raju founded Satyam Computer Services in Hyderabad. At the time, it was a small technology outsourcing firm, but Raju had big ambitions. He wanted Satyam to become one of the companies that would put India on the global IT map, and for years, it seemed like he succeeded. By the early 2000s, Satyam had become one of India's largest IT outsourcing companies. The company served major international clients. Fortune 500 companies trusted them with software development, IT support, and complex technology projects. Satyam's growth was explosive. The company employed more than 50,000 people. It operated in over 60 countries. And its stock was listed on the New York Stock Exchange, giving it global credibility. Investors loved the story. A fast-growing tech company from India, delivering strong profits year after year. Raju was celebrated as a visionary entrepreneur. Awards poured in. Business magazines praised his leadership. To many people, Satyam looked like the perfect success story of India's booming technology industry. But behind the scenes, the numbers were not real. The first cracks started appearing quietly. Analysts began noticing something unusual. Satyam's reported profits were strong. Its cash reserves were enormous. But strangely, the company wasn't generating the kind of real cash flow that should match those numbers. Still, few people questioned it too deeply. After all, Satyam was audited by a global accounting firm. It had prestigious clients, and its chairman was one of India's most respected business leaders. Then, in December 2008, something strange happened. Raju announced that Satyam would acquire two infrastructure companies that just happened to be owned by his own family. The deal was worth $1.6 billion. Investors were shocked. Why would a software company suddenly buy construction and infrastructure businesses? The market reacted instantly. Satyam's stock price crashed. Within hours, investors forced the company to cancel the deal. But by then, the damage was done, because people had started asking questions. And once the questions began, the entire empire started to collapse. Less than a month later, on January 7, 2009, Ramalinga Raju wrote a letter to Satyam's board of directors. It would become one of the most infamous confessions in corporate history. In the letter, Raju admitted that Satyam's financial statements had been manipulated for years. The company had been falsifying profits. It had invented cash that didn't exist. According to the confession, Satyam's balance sheet included over $1 billion in fake assets. Cash balances had been exaggerated. Interest income had been fabricated. Even employee numbers had been inflated. Raju described the fraud as riding a tiger, not knowing how to get off without being eaten. For years, the deception had grown larger and larger. Each quarter, fake profits had to be added, just to cover the previous lies. Eventually, the gap between reality and the reported numbers became too large to hide. When the letter became public, it shocked the global financial world. Satyam's stock collapsed almost instantly. Within days, billions of dollars in market value vanished. Investors around the world suffered massive losses. Employees feared the company would collapse completely. International clients panicked. Many worried their critical IT systems were being managed by a company that had just admitted to massive fraud. India's reputation as a reliable outsourcing destination was suddenly at risk. Regulators moved quickly. Ramalinga Raju was arrested within days of the confession. Several executives and auditors also came under investigation. Authorities launched one of the largest corporate fraud investigations in Indian history. Forensic accountants began digging through years of financial statements, and the scale of the deception became clearer. Fake invoices, manipulated bank statements, fabricated accounting entries. The fraud had been carefully engineered to make the company appear far more profitable than it actually was. The consequences were severe. Raju and several other executives were eventually convicted. In 2015, an Indian court sentenced Ramalinga Raju to 7 years in prison for fraud and criminal conspiracy. The scandal triggered lawsuits from investors across the world. Auditors faced intense criticism for failing to detect the fraud earlier, but the biggest fear was the fate of Satyam itself. With its reputation destroyed, many believed the company would collapse, and if it did, tens of thousands of employees could lose their jobs overnight. The Indian government stepped in. In an emergency move, regulators dissolved Satyam's board and appointed new directors to stabilize the company. Then they organized a rapid bidding process to find a buyer. Within months, Indian tech giant Tech Mahindra acquired Satyam. The company was eventually rebranded and integrated into Mahindra's operations. And incredibly, the business survived, but the scandal left a lasting mark on India's corporate world. It triggered major reforms in corporate governance. Stricter auditing rules were introduced, board oversight was strengthened, and regulators began paying far closer attention to financial reporting. Satyam became a warning, a reminder that even the most respected companies can hide dangerous secrets. Today, the story still raises uncomfortable questions. How did auditors miss a billion-dollar fraud? Why did investors trust the numbers for so long? And how did a company with global clients manage to fabricate its finances for years without being exposed? Corporate scandals didn't end with Satyam. From global banking crises to crypto collapses, history keeps repeating the same pattern: big promises, blind trust, and numbers that look too good to question. But what do you think? Was Ramalinga Raju simply a fraudster who got caught? Or a businessman who lost control of a lie that grew far bigger than he ever intended? Let me know your thoughts in the comments. Because in the world of high finance, success is often measured in numbers. And when those numbers become more important than the truth, the line between a billion-dollar company and a billion-dollar lie can disappear overnight.